Things aren't going so well at Dell. The personal computer maker issues a warning on its second quarter earnings, and that short circuits the stock. Investors dumped the shares and they closed at their lowest level in years.
Oil services giant Halliburton dumps plans to spin off part of its business with an initial public offering, deciding instead to take another tack. That decision disappoints investors and sends Halliburton shares sharply lower as the most actively traded stock on the big board.
Microsoft finally takes the wraps off what was one of the worst kept secrets in years. We'll tell you what the company is now telling the public about its newest product.
And tonight's Market Monitor guest says forget about stocks. There are better places to invest your money. We talk with Renee Haugerud, Chief Investment Officer of the Gaultier International Fund.
I'm Susie Garrow.
And I'm Jeff Yasteen. Paul Kangas is off tonight. This is Nightly Business Report for Friday, July 21st.
Nightly Business Report is made possible by...
I'm gonna miss you.
Congratulations.
Good luck, Gary.
Bye-bye. Thanks.
Hi, Care Bear.
Leaving one job for another?
Hey, Gary.
Don't forget to take your nest egg. Objective financial advice can help you roll over your retirement money. A.G. Edwards, fully invested in our clients.
Franklin Templeton Investments, providing a unique perspective through the specialized investment expertise of Franklin Templeton Mutual Series and Fiduciary Trust. Franklin Templeton Investments, gain from our perspective.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.
Good evening, everyone. Technology stocks took it on the chin today, felled by unexpected news from Dell. The personal computer maker fell $2.19 to $19.91, or down about 10%, after warning second quarter earnings would come in about 30% lower than forecast. Dell says that's because the market is softening across the board and across the world for computers. So instead of earnings of 32 cents a share, which is what Wall Street was expecting, Dell now says its numbers will hit in a 21 cent to 23 cent a share range. And joining me now to talk more about Dell's problems is Richard Stice, computer hardware equity analyst at Standard & Poor's. And Richard, welcome to Nightly Business Report.
Thanks for having me on, Jeff.
You know, what is wrong with Dell with this particular announcement? They used to be that they took all of their competitors' lunch money, and now it seems like they can't get out of their own way.
Yeah, they've really struggled over the last, about the last year or so. And I think a lot of it has to do with less the overall environment and the fact that their competitors are getting better. If you look at what HP's done over the last year, their stock price has done very well, and they've closed the gap in terms of market share for PC sales. And then, of course, Apple, which has been very, very strong, and because in part of their halo effect, they've been seeing some excellent demand for their Mac products.
So you don't think that this is a broader problem perhaps for the U.S. economy or the global economy, a slowdown? You know, some people have been talking about that, about Dell as a sort of proxy for the technology economy.
Yeah, I would say I'm less persuaded by that, and more that this is really kind of a company-specific issue. And even if you go beyond the PC market, you saw excellent numbers out of Google, good numbers out of Microsoft. IBM's numbers were pretty solid as well. Motorola's numbers were good, and then you saw weakness with some of the chip makers with Intel and AMD. So I think it's more, instead of kind of a broad-based reflection on the U.S. economy and on the tech sector as a whole, that it's still largely company-specific, I think, at this point. In terms of what we're recommending as far as growth rates for the year in the PC market, we're at a rate of about 9%, which is about in line with the long-term rate. It is down from last year. But the rate this year, I think, is still pretty respectable.
So what do you do if you're Kevin Rollins and, you know, you go on the internet, you read things about problems with customer service and also some situations with their laptops where some of those were catching fire, a very small amount, but still they were having some issues with those. What do you do?
Yeah, I mean, I think you really need to head that off as quickly as possible, because that, to me, was one of Dell's differentiating factors, was the fact that their customer service was so strong. They've come out with some recent policies about getting rid of their rebate program, in part to sort of simplify the process for customers, but they need to really, I think, do a better job of focusing on that area and sort of getting back to the kind of the allegiance that they had developed prior to some of these more recent problems. And if they don't, they're going to continue to cede share to some of the other players in the market.
And briefly, do you think Kevin Rollins' position as CEO could be in jeopardy with today's announcement?
I think if they have a couple more quarters similar to the one that they mentioned today, that could be a definite possibility. If you think back to Apple's situation where Steve Jobs left, they struggled, he came back, and now you see what they're doing. I think you could see Michael Dell step back in and take a more active role in the company again.
All right, Richard, thanks for your time on the program.
Thanks, Jeff. Appreciate it.
Our guest, Richard Stice, computer hardware equity analyst at Standard & Poor's.
On Capitol Hill tonight, work is underway to find a compromise on a pension bill, and it could be ready as soon as Monday. The agreement would help head off underfunding of the nation's traditional defined benefit pension system, but it might also impose new costs that could force employers to freeze or drop their plans. Washington Bureau Chief Darren Gersh reports.
One of the few unanswered questions about the pension bill is just how much relief airlines will get. Senators are offering the troubled industry 20 years more than other industries will get to fully fund their pension promises. Analysts say lawmakers from the House also want to help, but not that much.
No doubt about it. The airlines are going to get special treatment under this legislation. Both airlines that have frozen their pensions, and there's even options for plans that have not frozen their pensions.
Lawmakers have agreed that beginning in 2008, most companies, other than airlines, would have 7 years to fund 100% of their pension promises. Plans that are poorly funded would be allowed to gradually increase their contributions. Now they are required to come up with more money up front. Pension funding levels would be calculated over a shorter time period using a corporate bond rate. Businesses worry that will hurt their bottom line.
When you shorten the amount of time that you look at interest rates, you increase the chances that the interest rate will go up and down dramatically, and that will make it harder for them to predict how much they owe to their plans.
But with the Federal Pension Benefit Guaranty Corporation running a $23 billion deficit, Congress wants to catch companies before they get into serious trouble funding their plans. Lawmakers also want to make it harder for companies to use bankruptcy court to stick the government with their pension obligations.
There is a provision in this new pension law that allows the government insurance company to say, I'll lower your contributions in order so that you can keep your pension plan. We want to keep you, the company, responsible for the pension plan. And by the way, not only are we going to lower your contribution, we're also going to freeze benefits.
The pension bill will also affect workers with 401ks and IRAs, making it easier for mutual funds to offer investment advice. Darren Gersh, Nightly Business Report, Washington.
Dell's profit warning put investors in a selling mood across the board this morning, with the Dow dropping about 75 points in the first hour of trading. Overwhelming positive earnings reports from Caterpillar this morning and Microsoft last night. At midday, the NASDAQ was off 11, and with the situation in the Middle East remaining tense, buyers were few and far between. So the Dow closing down 59 3/4 points at 10,868.38 today. And this week, the index rose in 3 out of 5 sessions for an overall gain of 129.03 points. The NASDAQ composite falling just over 19 points to 2020.39 today. And like the Dow, the NASDAQ also rose in 3 sessions this week, but it fell nearly 17 points overall. And the S&P 500 ended off nearly 9 points to 1240.29. And in the bond market, the 10-year note falling 4/30 seconds to 120 30 seconds with a yield at 5.05%.
Two key inflation reports got a lot of attention on Wall Street this week and raised concerns about the impact of higher prices on the U.S. economy. That's led some people to worry about the possibility of a troubling economic scenario called stagflation. Suzanne Pratt explains.
For several weeks now, many on Wall Street have been talking about the nasty S word, S as in stagflation. Stagflation is the ugly combination of high inflation and high unemployment. Those are conditions that recall images from the 1970s of gasoline lines and urban blight. The last time the U.S. experienced stagflation was in the early 1980s, a time when the nation also experienced the worst recession since the Great Depression.
When we have stagflation, the U.S. economy is much more vulnerable to very severe recessions, because without a severe recession, the Federal Reserve is incapable of lowering inflation to a level that no longer distorts economic activity.
To be sure, no one is suggesting that we're currently experiencing stagflation. After all, the nation's unemployment rate has been steady below 5%, and GDP growth has been robust. Still, Wall Street is worried about the future, especially as inflation creeps higher every month and the housing market continues to slow. Some economists are raising red flags about the potential for stagflation, albeit a mild version.
I think that we might see a mini stagflation, where the unemployment rate goes from 4.6 to maybe 5.1, and inflation somehow levels off somewhere around 3%, which would be above the Fed's target. But I don't think that either of those conditions would persist for very long.
Others, however, are not at all concerned about the possibility of stagflation. While it's true that core inflation has been rising, the rate of unemployment has not. In addition, they point out that the economic environment has changed significantly in the last few decades. In particular, they say the U.S. economy today is far less rigid than it was in the 70s and early 80s.
They've been doing a lot of things in the last 30 years. We've been deregulating airlines, trucking, railroads, energy, banking, and all of that transformation of the U.S. economy has made it much more flexible. At the same time, the world around us is opening up. Countries all around us are wanting to go to work. It's a very global economy.
A global economy makes for heightened competition. As a result, it's far more difficult for companies to pass on higher costs to the price of final goods. That's one more reason economists say stagflation is unlikely to get a strong footing in today's economy. Suzanne Pratt, Nightly Business Report, New York.
Delta Airlines subsidiary Comair got a green light today to toss out the contract with its flight attendants. A bankruptcy judge says Comair can now impose wage and benefit concessions on its 970 flight attendants. Concessions Comair says it needs to emerge from bankruptcy. The carrier already has new contracts with its pilots and mechanics unions, but those deals are contingent on the flight attendants union accepting cuts as well. Before today's ruling, that union, the Teamsters, had threatened to strike if the contract was voided. Jeff, today a spokesman said it was disappointed with the decision.
Oh, you recall Delta and Comair both filed for Chapter 11 last year, Susie. And now let's take a look at our stocks in the news tonight. And topping our list, Halliburton down $2.64, nearly $3. The company missed estimates by a penny because of its Kellogg Brown and Root division, which received less contract work for the U.S. military in Iraq. Plans are also underway to spin off the company to Halliburton shareholders as a dividend and not as an IPO as initially planned. Pfizer picking up 12 cents on its upbeat outlook. And there's Advanced Micro dropping a little over $3. Analysts sounding the alarm as the price war with Intel and Intel's new product lineup could spell trouble for AMD in the months ahead. General Electric dropping 27 cents and Lucent Technologies dipping a nickel. ExxonMobil falling 32 cents and then EMC dropping 13 cents. Ford Motor rising 9 cents. Several analysts cut their ratings on the stock, but the shares rose anyway despite yesterday's surprise quarterly loss. And Hewlett-Packard dropping $1.28 in reaction to Dell's gloomy forecast. Bank of America rising 49 cents. The stock is up about 4% this week. On Wednesday, it recorded a record $5.5 billion in profits. Caterpillar falling 73 cents. The heavy equipment maker logging a profit of $1.52 a share in the second quarter. It was a dime above estimates. The company raised guidance for continued growth abroad, but the stock fell anyway. Capital One Financial plunging over $8. Second quarter earnings fell 12%. More U.S. customers are paying their credit bills on time, so Capital One reaped fewer late fees. Also, the company expected to write down losses from credit insolvencies in the UK. And that news did not bode well for Capital One's pending merger with North Fork Bancorp. That stock tumbled nearly $2 despite posting stronger than expected profits. Arch Coal losing $2, about $2.25. Profits were way above last year's levels, but the worry these days is on weakening prices in the coal market. Peabody Energy suffered a similar result yesterday. And on the upside, Johnson Controls setting a high thanks to upbeat comments from several analysts who consider the stock attractive at these levels. They think the company's restructuring efforts will work out. Now, on to the NASDAQ, where Google rose about $3. The stock managing to buck the downward trend in tech stocks on the back of its better-than-expected earnings report last night. Several analysts have now set a price target for the stock of about $500 a share. Microsoft getting $1 and change. The software giant made it official. It will come out with a competitor to Apple's iPod music device. The Zune device will hit store shelves later this year. And then there's the reaction in Dell stock falling $2.19. Dell's latest profit warning tanking the stock. The last time it traded this low was in October 2001. Apple Computer advancing 22 cents. Apple's CFO dropping hints recently that the company may be working on an iPod-based cell phone. And then Intel edging up a fraction. It will debut new chips in the next 2 weeks. Analysts say it could give Intel some pricing power and help boost revenues. Amgen jumping $2.23. Investors liking the biotech's numbers for the quarter. $1.05 a share were the earnings that topped estimates by 11 cents. And then on to Broadcom falling $3.24. This chip maker getting shellacked after it warned that third quarter sales will be lower than estimates. Cisco Systems dropping 42 cents, Yahoo picking up 62 cents, and Qualcomm losing $1.41. PMC Sierra sliding $1.84. It issued a revenue warning for the third quarter and a new 3-year low for the stock. Petroleum Development surging nearly 6. The energy firm selling part of an oil lease to Marathon Oil for $354 million. And then Laureate Education soaring almost $8. Earnings were sharply above estimates, and it raised its full-year earnings guidance. Said enrollments for both its bricks and mortar and online sections look great, double-digit increments, and it's confident of 25% annual earnings growth over the next 5 years. Those are our stocks in the news tonight, Susan.
Jeff, they're staying put for the time being in Texas. That was a decision today by a federal magistrate in Houston for 3 British bankers charged with wire fraud related to the collapse of Enron. The 3 men had asked the court for permission to return home to England while awaiting their trial, which is expected to begin in mid-September. The 3 former executives at Greenwich NatWest are accused of colluding with Enron's former chief financial officer, Andy Fastow, in a secret financial scam. All 3 say they are innocent of the charges.
Monday, the challenge of producing a soft landing for the economy.
Here's a look at what's happening next week. Our Friday Market Monitor guest is James Grant, editor of Grant's Interest Rate Observer. On the economic calendar, Tuesday, June existing home sales and July consumer confidence come out. Thursday, durable goods orders and new home sales for June. Friday, second quarter GDP and the University of Michigan's final consumer sentiment reading for July. Also next week, earnings from 3M, Altria Group, American Express, Boeing, ExxonMobil, DuPont, McDonald's, and Merck. Our Market Monitor guest tonight is bearish on U.S. stocks and says the place to make money is commodities. Joining us now, Renee Haugerud, founder and chief investment officer of the Galtair International Fund. The fund is up 7.5% so far this year. Renee, welcome to Nightly Business Report and your first appearance as a Market Monitor.
Thank you, Susie. I'm happy to be here.
Let's begin by you explaining why you're bearish on stocks and bullish on commodities.
Well, a little bit different than the previous report. I think we're in a new paradigm, a new economic paradigm, and I don't think we're entering stagflation. We're entering an economic situation of inverse stagflation, the opposite of stagflation. And basically, as the previous report said, that the last time we experienced stagflation was in the early 80s. That was when we had a stagnant economy, high unemployment, and inflation. But what kind of inflation did we have? We had financial inflation. Interest rates were high, and equities were bottoming and starting to go up. In 81, 82, by 83, they were on the ascent. But commodities were actually going down. We experienced commodity deflation in land, commodities, low-end labor, concomitantly with the inflation of financial assets. Fast forward 25 years today, and basically, I believe we're in a situation the opposite. We don't have a stagnant economy. I believe we'll slow down a bit, but it will be relative growth as opposed to stagnant. And yes, we will have inflation, but what kind of inflation? Commodity inflation, and not financial inflation. In fact, the silos are empty of commodities and full of money. So money is like grain of the 80s, at a price it can be had.
That's an interesting way of putting it, and that's why you think that investors should have a larger amount of commodity investments in their portfolios rather than just U.S. equities, right?
Absolutely. I think the recipe of saying whether you're 80%, 50% stocks, and you hear a few people saying put 5% commodities. Well, commodities are the thing that are going up. I think you should be up to 50% in commodities. Okay. Commodities are like equities of 1993. They're going to get overvalued and stay overvalued because they're in short supply and they're undervalued.
Well, let's go over some of the commodities that you find attractive. And at the top of your list, you put corn. Tell us why you like corn.
There's various reasons that I like corn. One, it's not only a food, it's now becoming a fuel with ethanol, and it's a feed for livestock as well. In addition, basically we are at below, on inflation-adjusted rates, corn is very, very low. We're at about $2.40 a bushel. And I calculate that with increased fertilizer costs, with increased land costs, with increased energy costs, the cost of production now is up around $2.40 to $2.50 a bushel, where the last 15 years we have been down around $1.80 to $2.20 a bushel.
All right, Renee, let's move along because I'd like to get some of your other choices in there. I know you like soybean oil. What's attractive there?
Again, soybean oil is another fuel. We basically believe that there is going to be demand destruction in fossil fuels in favor of biofuels. Ethanol is getting all the play right now, but biodiesel could be a big factor as well. And in the diesel fuels, what you use is you use oils. So you use palm oil, you use bean oil, you can use canola oil, and bean oil right now at $26 is good value as well.
Now, you're bearish on crude oil, but you're bullish on natural gas. Where do you see crude oil prices going, and where do you see natural gas going?
I am overall bearish on crude, but again, I caution against shorting it because we do have the political situation and the climate situation if a hurricane should blow through Houston. So I personally don't agree with being short, but there's plenty of supply around. It's basically the refining capacity. We could see oil going back down to $50, $60. We think 75 to 85 is definitely overvalued.
And how about on natural gas? Do you see on natural gas getting back up to $16?
Eventually, over the long term, this year I think it will be a little bit difficult, but basically, we came from the early 90s where we were at about $1.50, $1, $1.20 per million BTUs.
Renee, I'm
now
sorry.
we got up to
I hate to interrupt you, but we've really run out of time. But very interesting thoughts and very different than what we usually hear. Thank you so much for coming on the program.
Thank
My
you.
guest tonight, Renee Hargerud, founder and chief investment officer of the Galtier International Fund.
And recapping today's market action, stocks end the week in the red, with the Dow falling almost 60 points and NASDAQ loses 19. And learn more about the stories in tonight's broadcast. Go to Nightly Business Report on pbs.org. And that's Nightly Business Report for Friday, July 21st. I'm Jeff Yazdeen. Have a good weekend, everyone. And Susie, you have a good weekend as well.
And you too, Jeff. I'm Susie Garrett. We'll see all of you again on Monday night.
Nightly Business Report is made possible by
Franklin Templeton Investments. Our unique perspective helps us see domestic and international markets in a different light. Franklin Templeton Investments. Gain from our perspective.
And by A.G. Edwards.
This program was made possible by contributions to your PBS station from viewers like you. Thank you. For more information about investing, you may order the NBR Video Library of Personal Finance by calling 1-800-535-5864. This program is available in either the VHS or DVD formats.
We are PBS.
Funding for local broadcast of Nightly Business Report has been provided by viewers like you and by the following. IMS Capital Management and the IMS family of no-load mutual funds, celebrating 18 years of serving Northwest.
Is advised.